narrative shifts. Let's begin and continue that conversation. Bob Elliott of Unlimited, Jim Bianco of Bianco Research. Gentlemen, good to have you with me this morning. I've got Mizuho in the last 5 minutes coming in. No reason to see a cut on the table this year. Torsten Schlock talks about last week at Apollo. No reason. The risk is no cut this year. Listening to the narrative and how tight this is. Jim, can I get to you first of all? You talk about a no landing scenario. Can I put you down for no cut this year?
Yeah, you can throw me into that group as well, too. I was at 0 to 2 cuts at the beginning of the year, and I'm more closer to 0. And the no landing camp, what it means is what I think Jay Powell's trying to say. He wants to cut rates. He just doesn't have the data to do it. It's too strong. The inflation data, I believe, is showing signs of bottoming, and it's bottoming at way too high a level, near 3%, not near 2%. And the economic data is too strong for him to be cutting rates. So he'll wait, and he'll wait, and he'll wait. And then I think the calendar's going to run out, and we're going to wind up with no rate cut this year.
Okay, so you're joining that band, and of course you talk about a reevaluation of inflation and the interest rate expectations. So good morning, good to have you with us. Let's talk about the no landing, no rate cut scenario. Bob, I take it you're a little bit less keen on joining the no rate cut camp today.
Well, I think the main thing to focus on is the ordering, because the ordering of market conditions is going to determine the Fed's policy. And the way that I describe it is until bond yields rise, the Fed is not going to cut. And the reason why that is that under the current interest rate structure, this economy does have an incredible amount of momentum. Asset prices are reaching new highs. Employment continues to chug along. Income growth is strong. And so what interrupts that cycle is it doesn't just fall on itself. What has to happen is we have to have a rise in bond yields. That rise in bond yields has to start to slow the asset price appreciation, and that has to start to shift the amount of demand coming from consumers. But the ordering matters. So that's why I like to say until rates rise, the Fed will not cut.
But, Bob, the rates market has retested near-term highs without any demonstrative hit on the equity market. So are you talking about a more extreme pricing in bonds to the upside?
Yeah, I mean, just think about if you just go back last summer, what we saw bond yields rise up to 5, and we only got a modest equity correction in response to that, and not nearly enough for long enough in terms of the rate rise to create a drag on the economy. Now, fast forward, we're basically 9 months later, 6 to 9 months later, and asset prices are reaching even higher levels. There's even more positive momentum in the economy. We're seeing actually cyclical upticks in areas like manufacturing, global exports, et cetera. And so in order to get that slowing, at this point, we probably need to move yields back up to the 5 or even higher in order to slow the economy.
Bob, you're sort of trying to give people a little bit of a heart attack here. Jim, come on, join this. What's the risk of, I say that. If markets, could they retest 5%, Jim, in your view, in terms of a yield pop, if this inflation remains sticky? Have a look at 5-year break-evens, gentlemen, and to our audience this morning. Have a look at 5-year break-evens, because that's where the sticking point is for a lot of the swaps traders. The break-evens are perhaps underpinning Bob's hope that we will retest higher ground in yields. Jim.
Yeah, I agree. I think that we are going to do that. And I think that when rates go up, I agree with Bob, that the equity market or the risk markets will have indigestion. Now, one of the reasons that they don't have indigestion now, because you can argue we've gone from 380 on the 10-year note to about 420, is because of what just happened an hour ago. Chairman Powell says, I will cut rates later this year. And the stock market says, okay, I'm not going to quibble about March or May or June. He says he's going to cut rates, start pricing it in. And 16 of the last 18 weeks, the stock market has been higher on this underpinning that we're going to see a rate cut. And we're going to see the competition from interest rates come down. Because I think one of the problems the stock market has with interest rates is the long-term prospect for the stock market is about an 8% return. And if you could get 5.3 in a money market fund, I think there's a lot of people who say, I'll take that with a $1 NAV every single day, as opposed to taking risk to try and get an 8% return. So if the Fed cuts rates, we could dust off the TINA argument again and try and push everybody back into the equity market. And that's what it's assuming is going to come. And later this year, if it winds up that the data's too strong and yields go up, I think that then it's going to run into that indigestion that it's not going to get that.
Well, look, I could do battle with you both all day. You know, Team Transitory was wrong. We then have people calling for rate cuts. Various super economists out there calling for earlier rate cuts. Bostic throws a kite up there of one cut and done. But I need to understand, if you're both saying the risk is actually for higher rates, I just wonder then what you make of this. This was a conversation we had with Amy Silverman this morning. In a post-COVID regime, the right-hand tail, right? So the right tail is the new left tail. Basically, the biggest fear for investors is that the upside, not the downside. Now, you're both giving me a view that we could test higher rates. But all the risk, all the momentum in this market is for, my gosh, I don't want to be left out of the upside. So Bob, equity market risk. Do you agree with Amy?
Well, I think if you look at the history of equity market expansions, the way in which equity market expansions end is that, at elevated valuations, it's not because valuations are so high. It's because there's a tightening which pricks, either a bubble or an elevated equity price. Mm-hmm. And so I think a lot of investors are seeing right now the consequences of the self-reinforcing positive dynamic that exists with an equity market expansion flowing back and reinforcing underlying economic strength. But without that prick, that can continue. And if you look back through time, getting short ahead of the tightening of monetary policy is a recipe for lagging the equity market performance for a long time.
Jim, I mean, this was quite a gripping narrative this morning on Bloomberg Brief, which is, I get it, it's weaponized FOMO. If you're not in, and I'm not in on NVIDIA, I'm not in on the Mag 7, whether it turns into the Mag 5, if I'm not pro-risk, I do run this real risk of getting left behind, whether it's in credit, whether it's in equity, or indeed, for that matter, Bitcoin or gold.
Oh, no, I think you're right. And I think that the Mag 7 has morphed itself into the Fabulous 4 as those stocks have just continued to power higher right now. And people are looking at it and wondering, it's kind of a conflicting narrative, because we've got the stock market going up and we've got everybody FOMOing into the stock market at the same time. Yeah. We've got economists openly talking about the potential of a downturn, the potential of a soft landing or something worse, and that the Fed has to cut rates to respond to it. And those are, like I said, in conflict kind of stories right now. But I think that as the stock market continues to move forward, one other thing that was in that quote was about being a post-COVID economy. Yeah. What we're learning about the post-COVID economy is the propensity to spend is much higher now than it was, say, from 2010 to 2020. So if the stock market goes up and gives you unrealized gains, you're going to spend more of it. And spend more of it is going to push the economy higher and is going to put a bid for prices, which is a fancy way of saying inflation's going to bottom and inflation might stay sticky. Because unlike 2010 to 2020, when the stock market went up, we were just satisfied that our brokerage statements were larger. Now we're going to use some of that money and we're going to spend it.
Okay, well, we need something to supplant perhaps the COVID rush that we had. Bob, Jim, stay with me. More work to do. Bob Elliott, Jim Bianco. My guest this morning, joining me now. Bob Elliott and Jim Bianco are my guests this morning. Bob, Jim, here we are. You've got 9 months of this, gentlemen, to talk about political risk every day. So I just wonder if we step back for a moment and I say to you, fiscally, to me, both these candidates represent fiscal largesse. Bob, to you, first of all, it would reinforce your 5% call on yields if there really is a fiscal mandate coming, let's say, from the Trump house. But how do you think markets will inch towards the November election?
Well, I think they're probably not going to be particularly influenced by whether the election outcome is either favors Trump or favors Biden. There may be certain individual stocks that might benefit or not based upon the incremental difference in the policy, like higher tax stocks benefiting from a Trump administration. But that's pretty on the margin relative to the fact that both of these presidents, if they were to come into office, they're going to run very large fiscal deficits and be supported by Congress in doing so. And what that does is two things. It perpetuates a support to the macroeconomy and the continued strength. Yeah. In addition to the fact of creating all that bond supply to fund those large deficits on an ongoing basis.
Yeah, well, let's see what the ratings agencies have got to say about that, depending on who sits on Capitol Hill. Jim, it's probably a bit too early, and I think you make this point, which is it's a bit too early to put together baskets of higher tax, lower tax companies, or is it?
No, I think it is too early. I agree with Bob that on a fiscal standpoint, they're both going to spend money, and that's going to make the economy stay strong, and that's going to keep the borrowing higher, full stop. Now, where they might differ is when you start getting into non-economic numbers, whether or not you're talking about foreign policy or you're talking about the south border or something like that and how that might impact it. But then again, even if we start getting into those types of things, it's really hard to say one policy differs from the other. So here's a basket of stocks you'd buy one way, or here's a basket of stocks or what you would do with the bond market the other way. So right now, I don't think that this is really playing. I know we like to ask the question, is the Fed really playing in the markets? And the answer might be yes or no. I would actually turn that around and say politics really isn't playing in the markets. But again, it's still 9 months away.
If I said to the two of you, what is a gray swan event from the political spectrum, Bob, what would you say that could look like?
I think the main question is dysfunction and whether or not they can continue to operate the government in a time where we still have divided government and it may become more divisive heading into the election. And that could create second and third order consequences and a drag on the economy if they can't get things like budget and spending done.
And for you, Jim, what would you say could be a grey and disruptive emanating from political landscape?
That the two candidates that we assume are going to be the nominees, that one or both of them doesn't. One's on trial and might be convicted, and the other one is running behind, and his party is very, very upset or very worried that he can't win and that we might see a change. It's a low probability.
Jim, are those low probabilities very left-tail risks?
Yeah, I think so. But I mean, they could really change. They could be very, very disruptive if you see one or the other or both winding up changing between now and, say, the conventions or election day. Low probabilities, but they're worth mentioning. They're still out there. You see them in the betting markets. The betting markets have got them, that there's a non-zero probability that there could be a change.
OK, well, certainly the two of you have given me food for thought in terms of where we can go with bond yields and non-zero probabilities. Bob, Jim, thank you very much. My guest this morning coming up in the show. Of course, your morning.